everyone and welcome to SmallCap Spotlight. I'm 𝐀𝐦𝐤𝐭 𝐆𝐴 and today I'm in the offices of Nisus Finance, a company that specializes in real estate. Now when I mean real estate, I don't mean that they're building real estate, but they're investment managers and specialize in financing of real estate as well as creating credit solutions for them. I have with me Dr. Amit Goenka, the Chairman and Managing Director of the company. Thank you so much, Dr. Goenka, for joining us.
Thank you very much for having me on your show.
So to begin with, if you could just give our viewers a brief introduction into all the business verticals of Nisus Finance.
So Nisus Finance, as you rightly introduced, is a predominantly real estate and urban infrastructure player within the capital space, which basically means that we handle the entire development life cycle from concept to execution to delivery, where there is intervention of knowledge, intervention of expertise and intervention of capital, which is clearly the largest bloodline for the sector. So effectively, it invites us to do two things. One is on the advisory front, because when you're seeing close to 70,000 crores worth of deals a year, you find that every opportunity is unique, every problem is unique, and it requires curated ideas and solutions, which one is able to assemble because of the vast experience that one has, because you're working the landscape for multiple years. So you know exactly how people are operating in parts of the globe, to parts of the country, to various capital backing, to various structures and solutions. You're able to assemble all of that know-how and provide a very curated idea or a solution to those seeking it. So that becomes an advisory and transaction advisory vertical. What it also allows us to do is actually learn from others' mistakes. So what other fund managers are doing, what other NBFCs and banks are doing, what are they doing wrong, and how do we improvise that when we're actually coming to putting our own capital to work. So there's a lot of efficiency that goes into the advisory business. It has also formed a very significant part of our revenue for so long. Almost about 65% of our revenue came from the advisory vertical, because it's a very high value accretive business. Somebody comes to you with a 1,000 crore project, you charge 2% of that, and you know, lo and behold, you've got 20 crores. You'll get that only if you, and you can do that multiple times in the year. Whereas you can put 1,000 crores to work and still get 20 crores, but once a year. Right? So therefore, obviously, that became a very large value creative opportunity for us. Of course, fund management is at the core. You know, how do we invest capital? Where do we put it to work? So that's the other part of our business, where we employ large scales of money across multiple funds for specific urban infrastructure opportunities, which are directed at a very unique idea at that point in time. So these two ideas are really what builds Nisus Finance at the core. Then, of course, there is a separation of geographies. We've done this business pan-India. We've expanded across the realm of India beyond the 4-5 metros. And now we've gone across the border to the UAE and capturing the GCC region as a whole. So we set up operations in Dubai and offering the same twin model of advisory and investments. So effectively, it's a 4-part model between advisory and investments in India as well as the UAE.
Okay. So I see how the two complement each other, because you watch transactions happen and then you deploy that knowledge essentially in fund management. So I think that answered my next question. But I want to ask you, what came first for you in your personal career? Was it the finance angle of it or your knowledge in real estate? I just want to understand how Nisus came about.
So finance has been the core driver for me. I started the journey in finance in the late 90s, early 2000s. In fact, I was more hell-bent on being an engineer and doing R&D. I realized India does not offer R&D opportunities, and therefore, and even if you created something, the first question the management would ask you is, what is the payback, what is the IRR, what is the ROE? I'm like, what are these terms? Hadn't done all of that, so moved to finance in a very big way. Started with mergers and acquisitions, accelerated on that, and corporate finance, in investments, and saw a very large landscape of that area across the globe. Invested close to $6-7 billion across 4 continents, and that gave me a very deep understanding not only of finance but asset classes, industries, legalities, regulations, risk management, etc. So in doing all of that, obviously it was overwhelming. You are understanding multiple sectors at a time. You're trying to, but then it never gives you enough satisfaction, because you're never able to deep dive into one space. So if I'm working in the automobile market and I'm buying in a car company, I can only do so much in understanding what a car company does. I can never actually be there and run it, right? Likewise, when I'm doing FMCG, likewise when I'm doing industrial or chemicals, you know, you can only do so much as a finance professional. So I said, it's time for me to be specific to a sector. And then the question was, which sector? And I started to think. I said, well, what is going to drive the future? In my mind, the answer was clear. It has to be urbanization. While technology will be important and healthcare will be important and everything else will be important. But the end of it, if you do not have proper infrastructure, Will you get capital? The first engagement for anybody who comes to the country is the infra of the city. What kind of roads, what kind of airports, what kind of hotels, what kind of office spaces. Do you want to come into a rundown, dirty, unkempt city, or you want to be engaging with a very clean and a very, very nice looking location? So I think that was very clear to me. In 2005, press note really paved the way for global capital to start coming and investing in the country. And then 2008 had just happened. And what that did was it actually shifted the entire paradigm for investing in real estate, because in a lot of ways, the entire global financial crisis was predicated on over-engineering real estate investments. It was on US mortgages. So when we had RMBS, CMBS, synthetic structures, and I'd done all of that when I was in London or I was in the UAE doing investments. And I realized that this is going to be a new paradigm. It's going to bring capital, which is more serious, which is actually driving to build assets rather than only skimming returns through structures and synthetics. And that is where the next wave of development will be. And there's this journey which has just started. It's not an industry which has even formed. There are no serious players. There is nobody. There's hardly any IPO companies, hardly anybody in the public domain. DLF and some of the largest developers went public much later. So when you see this formation or this trend starting, I knew in the next 20 years, this is going to be a force of the economy. And therefore, it's better to be part of that force today and help shape it rather than just riding as part of others. And always was interested in creating alpha or a differential path. So when everybody went left, I went right. Just a rebel nature of me.
So why not directly get into real estate development? Why the finance route?
See, finance is the backbone of discipline. Because finally, capital decides what gets built, how it is built, how it is consumed, how it is perpetualized or democratized, and what are the bells and whistles required of the operator. So finance is the diktat. And without that diktat, the developer is free rein. Which is exactly what happened in the first slate of things. So almost, we'll be surprised, almost $13-14 billion came to the country following Press Note 2, and everything went out of the window. People lost a lot of money because there was nobody within the development companies who knew exactly how to work that rope. Even the people who brought in the capital did not know how to actually rein in the developers, how to actually get them to behave. They started learning that. They started to understand that you just cannot give money and hope that will happen. You actually have to produce results yourself. You have to guide the team to do it, because we've never done things at scale. We've never built 100 million square feet of office space, the size that we're consuming today. Right? So when you've not done that, how do you actually make it deliver? So capital is the driver. And unless you control capital, you can't control anything, which I learned way back in engineering days, that you need to control capital to control the organizations and outcomes. So therefore, capital became a natural part of it. The other thing is that, way back, or maybe 17, 18 years back, India was still at an infancy of development. You did not have so many high rises, you did not have data centers, you did not have grade A warehouses, you did not have, high grade commercial buildings. It was very, very rustic. It was very, medieval, very, very elementary. And so it needed to actually catch up in technology, in processes, in governance, in systems, in the ability to actually follow a certain code of conduct, which RERA brought in, etc. eventually. So without that, being part of that means effectively wasting energy on an organization or on a platform which is not going to be ready to actually deliver, because why break what is working is usually the mindset. If everybody is building it, why don't you do the same thing? So capital can change that thinking. So therefore, it was very important for me on the capital side. So really, real estate, and again, I realized also that I'm not the smartest guy in the room, Rubina. Let me be honest to myself. So if I go in technology and am I going to get an IP? I'm going to build the next Google. Am I going to be able to be a change in technology? Maybe not. But can I create a large change in urban infra? I can. And that's when I realized that, andho mein kana raja. If you are half smart amongst equals, maybe you have a better chance of going ahead. So I realized this is a great opportunity, and I found a great platform to actually exercise my knowledge, exercise my will, be experimental about it, see what is the best way to move this industry forward with capital. And that's really how real estate happened. And of course, it's a very engaging asset class. What you can see, what you can feel, what you can experience, what you can engage with, what you can conceptualize and actually see it getting done is a very new feeling. It's a new high, something you don't get to see in other sectors.
True, very true. Anyway, now you are kind of in the real estate. We'll talk about that in a bit. But the way you explained your business verticals, transaction advisory and fund management, it looked like the transaction advisory one seemed a bit more reliable in terms of your income stream. Yes, fund management, of course, is a big part as well. But I want to know what the split is, because as I understand, fund management is getting bigger and bigger. Understandably, for obvious reasons, right? India's urban infrastructure is booming. So you're one of the beneficiaries of it. So how would you look at this mix changing? Would you be worried about that predictable source of income perhaps pausing for a bit or getting lesser?
So I think while both are important, see what advisory did for us, of course, apart from being very strategic in terms of knowledge enhancement, gave us very large streams of income over very short periods of time. And that allows us to always stay very positive and growth oriented. But what AMC does is it gives you very long-term annuities. So let's say when I manage, for example, 10,000 crores and I'm earning, let's say 2% a year. I know I'm going to continue to earn 200 crores a year of annuity for the life of the fund, which is 6 or 7 years, without worrying about whether transactions are going to happen or not. So it gives a very long stream annuity for me, which is very important because it then sort of cushions your downturn. It cushions all cycles. You know your cost base and your profits are covered at all times.
So I got it wrong, actually. This part of the business gives more predictable.
That's right.
All right. Okay.
That's right. So the predictability of AMC is obviously a given, which is why it needs to be obviously larger. And it is happening like that, So the markets always question, when will AUM become large enough that it becomes the most significant part of your business? And it will at some point. But then losing transaction advisory is a bad idea because it gives very significant jumps. Also, we've also demonstrated over the last 15, 16 years, Mubina, that there's a very strong correlation between advisory and investments. See, what happens is when you're putting, let's say, 1,000 crores to work, the type of deals that will come to you are also which are going to fall within your bracket. 50 crores, 100 crores, people, because they know this is what you can do.
Yes.
Now that's the deal flow you're going to get. Now within that deal flow, you'll end up maybe doing 2% of those deals. The rest of the 98% can become potentially your advisory clients. So the larger you become, the larger value and volumes of deal come to you, and therefore the larger the advisory income. So we've always shown there's been a constant correlation between how much AUM you manage, how many products you manage, and what kind of advisory income you generate. But having said that, but you cannot obviously grow at the same speed as AUM, right? So when AUM is growing faster, obviously today the ratios are shifting from 65-35 to 50-50 and potentially 60-40 in favor of fund management over the next 2 years, which is also great because it gives you very long-term annuities to begin with.